Welcome to another episode of Benny and the Squirrel. Today we're lucky to have our buddy Tom Roderick, portfolio manager of Trium Capital. Tom's a global macro manager, started his career at Brevin Howard, and got the privilege to work for my buddy Hugh Hendry at the Eclectica Fund, and now is scouring the world for interesting trades. It's another one of those episodes where I'm the only American surrounded by two Brits. Welcome, Tom.
Welcome,
thank
Tom.
You. Thanks so much for having me. No, we were just talking about, we've all got a little bit of British memorabilia. I've got my little Welsh dragon in the back, and the squirrel, of course, has got his cushion. So,
So let's get it going with the news of the day, just because it's topical. I don't know if you have an opinion on it, but we wanted to talk about it just a little bit, and then we'll get into a few other topics. Is this, we're seeing the redemptions at Blue Owl, we're seeing BDCs and Ps, and now credit spreads are starting to go up. Do you have any concern about this? What's your thoughts, either about the Sassacre or about the impact on credit spreads? Any thoughts going on here?
Well, I think we seem to be entering into a world where financing is just going to become harder to get. There's just more and more people trying to get financing. You're going from this capital light software model, which is beginning to come unpicked a little bit over the last couple of months, and we're going into a more infrastructure heavy environment. It seems, even now, like the cutting edge of tech is getting very, very expensive. And when you look at the hyperscalers, you're reaching beyond the point where they can pay for it out of revenue, towards the point where the entire business, even the big boys, need to raise capital. They need to raise capital, be that private equity, public equity, these sort of side deals that we've seen for data centers, or through credit. And so, one way or another, it's gonna hurt listed asset prices because there's a big capital raise coming. And so I think everything gets hurt. I think we're probably going to see a shift towards equity issuance this year. You've got these big IPOs in the form of SpaceX with xAI, OpenAI, and Anthropic, who are all talking about raising huge amounts of equity capital in a market which is used to the share count just going down every year. That's a big deal. And then on top of it, you need to raise all this new debt to fund some of the data centers, some of the private people who are helping with the data centers. So, looking from a sort of a 20,000 foot perspective, there's just a serious amount of new cash which needs to be taken from somewhere and put in the hands of people who think they've got good ideas of how to spend it. And a good portion of that, I think, has to come out of the existing capital base. And so, people are going to have to sell down other bonds, other equities to make space in their portfolios for all this issuance that needs to happen.
So we had Louis Gave on the show last week, Tom, and one of his sort of big sort of truisms around the China market, which we're going to talk about later, is that the Chinese markets always used to get killed by people like me, equity capital markets bankers, right? Supply ultimately is what always traditionally caused the Hang Seng and Chinese equities generally to roll over. So I kind of agree with you on that. But at some point, these are rational human beings. These are not state capitalists. At some point, don't one or two or more of the hyperscalers tap out of this, AI capex arms race, or do they just carry on thinking it's existential for them?
So far they seem to be very much willing to pay the price to stay in the game. The way that they talk about it is if it's, the pitch is it's a national security issue. If the US doesn't win, then it's a problem for the state. And if you put it in that context, I think it's fairly unlikely that we see any of the hyperscalers sort of back out in a meaningful way. I think Microsoft is sort of threatened on occasion, but ultimately they're developing their own chips. They wanted to build their own data centers. They want to have that as their own pillar outside of OpenAI. Meta Mark Zuckerberg is famously known for wanting to spend money on whatever crazy new idea he has. And, quite frankly, I think AI has a better chance than some of this metaverse stuff. And so in that sense, I think it's at least something which may have a return in future. Amazon and Google, I think, they need huge amounts of compute for themselves to serve their ads. Meta needs it for advertising algorithms. And so I think it will, we're still in a compute constrained world. And so getting access to that compute is still somewhat restricted. And so long as the perception of that remains, I think all of these guys are just going to want to stay in the game, until the bottleneck becomes something else. Maybe when the bottleneck does truly become power rather than compute, and you see some of these other costs skyrocket even more, than someone sort of might tap out. But I think it's going to continue, and I'm sure people will fall by the wayside. There will be people who get a bit over their skis. CoreWeave almost got that way last year, but sort of brought it back a little bit. Oracle got challenged. I think these challenges to the amount of debt or equity that individual companies can take on is definitely going to be challenged. But I think the game is going to continue. I don't see any of these big guys backing out. I don't know if your thoughts differ on that.
Well, I have a view on this. So, this idea that in bull markets, CapEx gets rewarded because you think, okay, increased returns, more free cash flow. And so we saw that with this AI build out where, it peaked, it had to blow off in September, where guys were just putting out flyers of non-binding agreements and driving trillions of dollars of returns. Then when you get into a bear market, this CapEx is not rewarded. And that's the market saying, no, we don't want that. And now you're starting to see that. And you saw it, Meta got hit first. Now you're seeing Amazon and Microsoft get hit. And ultimately, the Squirrel and I have talked about this a few times recently, is that, these guys are stewards of their stock. And in the tech game, the stock-based compensation is very important for retention and recruiting. So they can't really have a down into the right stock, because it really is going to drive guys to leave. It's going to be hard to get new guys in. So the pressure is rising. I think Microsoft will probably be the first one to bend the knee. And I think that if you see the market pressuring them through equity valuations and credit spreads, that pressure is building. Now, they might keep going. I'm not saying they won't. But the first breath of, hey, we're pausing, or hey, we're decreasing, and all these stocks are in the fire hose of CapEx, the industrials, the memory, the semis, all the guys were now, because of the massacre, like there's a lot of money that just move in there. So those trades are kind of crowded. And so I think that's a dynamic you got to pay attention to. Not saying they call me or I know, but I'm seeing the setup essentially.
Yeah, no, like I hear you. Like I think it could go that way. If you do see enough pressure on the share price, then something has to give. My guess is they're probably going to push for job cuts before they sort of cut into their AI plans. And that's that. We've already got a bit of a K-shaped economy where you've got the top, corporates at the top with all of this spending power, doing pretty well. Sort of high-end labor is doing well, but at the same time, the US is not, and most of the rest of the world is not really creating any new jobs. And so I think that's probably the first thing to go. From Microsoft's perspective, I think you could make a pretty good argument that they just haven't executed very well on AI. The fact that Claude can come out and make a better Excel add-in for finance and for others than Microsoft can do themselves with full access to the base code is quite frankly ridiculous. And I think it sort of shows the reason, that they're getting, it's not quite working for them and their share price is being challenged is just because they're not playing the game very well. Whether they will decide to actually exit the game because of it, I'm not sure. They're not, if they exit, I think it'll be because they genuinely think there are no profits to be made. Whereas what's been seen so far is it hasn't been them. They haven't won. They haven't been able to execute effectively. And my guess is they're probably going to have another crack at it. They're probably going to want to try and get ahead of the game. Now that you're seeing all of this agentic stuff coming in, and most of us use Microsoft Office products as our front end for how we sort of run our day. I'm pretty sure they're going to have a crack at it. They're not going to want to give up that market, unless you go into some kind of a real sort of top line stock market correction where you see, the S&P down 25-30%. I think they'll keep on trying because the race is still on. They're going to be looking at Google's share price rather than their own share price, and they're going to be thinking, well, there's still room for us to catch some of this, and they'll be looking at the prospective market caps, which Anthropic and OpenAI are, likely to IPO at least at current valuations, and they're going to want a piece of that, I think.
Yeah.
I
just can't stop thinking that these guys had such great business models that were infinite cash printing machines, and now they're allowing their businesses to be hijacked by, compute elves and compute gremlins that basically guide people away from having to see their ads. It's completely disruptive. But let's switch gears from big tech and get back to where we started with this sort of Hunger Games for capital that's being created by this displacement at the top. Because I think that these private, I'm old enough to be, old-fashioned enough to believe that when you gated a fund, it was the end of your business. As an asset manager, that doesn't seem to be the case these days. But ultimately, yes, the PE funds have been using these offshore life insurance businesses as sort of permanent capital vehicles. But I think that game is largely played out. You've now got, ironically, Janus, who was, in the time of the dot-com, Janus was the alpha predator at the center of tech investing down in Denver. For years, it was a mandatory roadshow stop in Denver for Janus. And now that they're at the epicenter of trying to sell CLOs to retail in ETF format. There's a strange echo about all of this, Tom. And I just wanted to, I have to confess, I was early, which is wrong, to the private equity meltdown trade. And so I've been watching everyone else make money on the short stand here and not participating. But where do you see it play out, right? How do you see this story end with these guys?
I think you're going to see more differentiation of businesses. And I was talking to Ben the other day about why it is that SaaS businesses and Bitcoin are going down together, and came to the conclusion that it's just because this is the obvious funder. You've got people who are involved in this sort of novel, innovative, high tech stuff who need to make room for other investments. They feel that things are so fast paced, they need to clear out some of their book, regardless of whether the revenues of some of these private equity guys are challenged, which I do think they are. It's going to be very, very difficult for these SaaS businesses which sit inside private equity to be listed, and so they're going to have to take the hit. The PE ratios which they can IPO are going to be significantly less than they were before. That's going to be pretty tough. And so right now it seems high tech investors are using anything which is not really working adjacent to these LLM providers to sell. They're selling SaaS, they're selling Bitcoin, they're just looking for anything which has any kind of a story that it's not going to work. Private equity investments which are potentially disrupted by AI as opposed to benefit from. Sell. And so I think this is what's been happening. What we haven't really seen as much is revenue disruption. You've seen SaaS companies go from like 20 times PE to 35 times PE, and now I don't know where we are now, back to 17 times, which is still
Well,
being priced as a growth asset, but it's just not such a good one.
So, I was looking at this yesterday. So, the IGB ETF is still trading on 6 times forward sales, right? So, as a starting point, it's 6 times forward sales. Whatever your margin structure is a very, very big multiple, right?
Yeah.
And if everyone's questioning your future margin structure, I'm 1.5 bid on a sales multiple right now. I think there's a long way to go. And you say they're selling stuff, but who are they selling it to? They've got no one to sell it to, because they've already done the business of selling it to one another, right? And selling it into continuation funds, etc., which I think the game's slightly up on there. I don't see the exit. I just need to see the write down, I think, at this stage.
Well, the revenues have still been good, right? And their earnings, it's not an earnings based thing. It's a pure sort of forward looking multiple revision from a very, very elevated start in valuation. And this could, in some sense, I agree. This means it could go further. You could argue we're barely getting started. And the question is, what does the world look like when some of this transformative technology actually comes through? Do people use AI within Salesforce, within Adobe Photoshop, or do they find ways around it and it's just much easier to build your own software stack from the bottom up, such that you can just you can go around it? I've got a friend who edits video for a living, like extreme sports video, and films it as well. And for him, AI is an input into Photoshop. He can choose his model, and he can choose his start frame and his end frame, and he can make a cool bit of video between it. And so for him, it's being integrated into his day-to-day workflow. No decisions need to be made. You've got your Adobe subscription. They tap in on your behalf into large language models, and they remain the outlet for the end user. Much as I imagine Excel will remain the outlet for the end user of, let's say in the finance world or other sort of numeric industries, there'll be sort of add-ons to the existing software stack, because it's, unless you can sort of get someone to change to a whole new product set, I'm not really sure the future of sort of computer productivity is really going to change that much based on AI. Unless you can just completely remove the human, and you don't need that sort of
seat where you the seat removal.
Do you remove taste from the artist who creates the video? If so, you can completely remove them. But ultimately, we're all familiar with the term AI slop. So you've now got, I guess AI slop is getting better, but it doesn't beat AI combined with human taste. And I think that goes for, building spreadsheets, building any kind of a workflow. A lot of it is quite bespoke. And unless you understand the intricacies of what you're trying to do, it's quite difficult for someone to come along and disrupt you. And so, for that reason, I'm somewhat skeptical about whether SaaS will truly be a bad business model in future. And so what I think is happening, as I said before, is just people are just selling anything. There's more good stuff out there, and people are using it as an ATM. So long as the revenues of these companies continue to remain as is, I think they'll find a buyer.
And just remember how Wall Street works, right? Like, a lot of us was taught to be longer term thinkers. So much money is moved into pod shops where these guys can't really look out much more than 2 quarters, really 1 to 2 quarters. So if you're seeing this go on, you can't really be like, well, I'm going to wait to the other side. You might lose your seat, right? So you get guys having to sell, and it's baby with the bathwater. And we saw, look, energy in 2020, and I'm not software, there's some differences, but I was buying energy in 2020, and that was just the most hated land ever. You were an asshole if you were buying energy in 2020, although in historical look back. So I'm with you that there's probably some buys. We had my buddy Sasha and Dev Dougal on here, and he was talking about which areas of SAS, are sitting on air, or not sitting on air, but sitting on value, and some are sitting on air. So I think you got to go name by name. But I think that like the enterprise values are being re-rated. I think margins, there's enough uncertainty that you can't justify these high multiples. And the Squirrel's talked about this a lot in his newsletter and on the show with me. So it's not necessarily, oh, the business is over, as much as we're getting a re-rating, which is probably justified because there's an irremovable uncertainty present with these things right now.
Yeah, and also how much money is available depends on the Fed as well, right? So the question is, if you do get a bit of a market meltdown, you start to see this going from a relative value shift to S&P starting to tank. What does a Walsh-led Fed do about it? How much pressure can Trump put on? Maybe they expand the balance sheet. Maybe they just reduce rates. There's a lot that can be done, and it's not so obvious to me that something that's disruptive of this nature, whilst the capex is still being spent, is it's a sort of thing you're going to make room for in terms of monetary policy. I think the Trump administration will push the Fed. The easy money will come, and yeah, I'm not so sure about the sort of the absolute trade in relative value terms. And I don't know if I'm getting to this too early, but I really like the Hong Kong tech sector relative to
we
NASDAQ.
Can go there.
The reason being that valuations are already pretty unchallenging, even after some of this this sort of hit to SAS. It doesn't, the prices are reasonable, and at the same time, I think the software stack looks different. It's all under control of the hyperscalers.
It's very much that. I mean, just to walk through, you've got Hong Kong tech versus the Nasdaq in red there, and you've got implied vol ratios in the blue line there. Why don't you sort of take a step back, Tom, and just say, you alluded to your positioning. Just go through the sort of building blocks of how you got there.
Sure. So, to a certain extent, I share your concerns about the US tech industry, but ultimately, I think it's going to continue to be a multiple compression thing. I'm not sure it's going to kind of bring down the economy and be this sort of spiraling loop, which is going to feed off itself. And so, I can see a situation where Nasdaq is flat next year. Were that to be the case, my guess is that Hong Kong listed Chinese tech companies are going to do better, and to be long something against that short makes sense rather than to just take an outright short Nasdaq position. Hong Kong tech, if you look at some of the major constituents on the software side, you've got Alibaba, Baidu, Tencent. On the hardware side, you've got BYD and Xiaomi. If you look at the hardware side, there's much less of these kind of narrow, siloed SaaS businesses, which sort of tap into the middle layers of the software stack and are really open to disruption. If you look at the way that the software industry is organized in China, it's really much more vertically integrated in very, very large companies, which will both benefit and get hurt from any type of disruption that happens in the industry, because they're kind of big enough that everything is going on inside them. And so they're unlikely to be net losers in a world in which innovation is increasing. Whereas I think in the US, you've got these very, very narrow siloed companies. There's going to be some winners, there's going to be some losers, and everything has just been thrown up in the air. The market has recently decided, okay, right, we're gonna adjust down the PE multiples of software companies by a third. That's where we are at the moment. Is that where we land? I don't know, but I'd rather not be forced to take that decision when you've got a very cheap asset versus a very expensive asset, and you can trade one versus the other. And then on the hardware side, I think, China is very clearly winning in terms of battery technology, in terms of robots, and is becoming increasingly innovative on the chip side. And the assets we're talking about have been pretty neglected for a long time. At the same time, one last thing
I would just say, I mean, since last September, really, and this is the outright rather than the relative chart, but it's been sold off. EM generally has done pretty well, but China tech and EM tech has been rolling over since September. So that's the problem with pair trades. I mean, it's been a pretty tough tape in China tech recently, and I agree with you on the quality points. And I just wondered if you had some thoughts around some of the flows. EM's getting plenty of love, right? Yeah. But the tech story within EM is being sold off.
Yeah, well, so far it's been everything but Hong Kong. If you look at the Asia market, it's been on an absolute tear this year as well. Yeah, I agree. When you look across, Korean equities have been on fire. Latin American stuff less so this year, I guess, but has been very strong. There's been a lot of things that people can invest in from an EM perspective, and I think perhaps when that happens, people sort of don't want to take the political risk that they associate with China. I actually think that ultimately Trump's a businessman. If you look at who owns ByteDance, if you look at who owns some of these US listed Chinese ADRs, it's Trump's mates. And I think to a certain extent, he's not going to do too much. When you look at what Trump wants, he wants to create a deal. He doesn't want to block China from Nvidia chips. Much to the fury of a lot of the sort of the hawks in his administration, he doesn't want to block them off. He just wants to extract his pound of flesh and make sure the US government gets paid for its bit in ensuring the security of the trade. So I don't think that tech flow is going to get sort of turned off to China, and I think there's a bigger chance of sort of some decent rapport with China, which may even lead to some sort of a deal. And were that to be the case, I think you get US investors coming back into those Chinese flows after being away for many, many years. I think on the European side, you've seen a bit of a return of those flows. But it's been pretty slow. And the other thing I think is that there's been a change in the way that some of these companies are run in Hong Kong. Like one of the things which has really driven US equities has just been a net reduction in the share count since the GFC. Every year, whilst you do have stock option creation given to insiders, and you do have some new equity issuance, it's been hugely offset by very, very large buybacks. And so the share count at an index level declines every year. Until recently, that's not been the case in Hong Kong, and it's certainly not the case in mainland China. But it's the sort of the pace at which you get diluted has declined significantly within China. There's much better capital discipline, and it's been sort of enforced from the top. And so, yes, the last couple of months of flows have not been in Hong Kong's favor, but I think if you sort of take a step back and sort of look more long term, it's looking increasingly promising.
I agree with you, and I've got the trade on as well too, Tom. So I'm just looking for some bias confirmation. Yeah. Listen, let's talk about Korea.
Squirrel loves that. Squirrel loves that our guests come on and just pump his book.
So obviously, Korea is a market that's getting extraordinary flows right now, and Ben and I have talked about this a lot. I mean, this looks horribly like the silver chart at the moment, and I get that Samsung and Hynix are very cheap stocks, and that we're in a memory bull market that looks absolutely nothing like the memory bull markets that blew up so spectacular in my career past. How long can we ride this Korean parabola here?
Well, interestingly, even the price levels are pretty similar to silver. Where are we now? 100 at the high of 134. We've gone a little bit higher. I guess the long Korea short silver trade, which probably makes no economic sense, would have been a great one this year. But you know what I say? Right now, if I did have to take Korea risk, I take it in the FX, not the equities.
Yeah.
And that's just because, you know, that chart is backed up by revenue. You know, we know what memory prices are, and the reason why, you know, that index has gone up is mainly because of Samsung and SK Hynix, and their revenues are going to be off the chart next year. All of that money is coming into Korean won. You know, certainly there is a decent amount of foreign ownership, but even with that, net flows into the won are going to be enormous. The only thing which has been acting against that is huge outflows from residents who tend to want to buy US equities, foreign equities, anything that's not Korean. That may change, you know, if you do see a sort of a flat to down market in US equities this year. I think you'll stop getting some of those inflows, and you may see some capital repatriation back to home. And at the same time, some of the rules are being changed, so they're making it more favorable to invest at home. I mean, the numbers are astronomical. Like I'm not sure what the current account forecast is for 2026, but I think we're talking 5% plus. You know, if even just the hedge ratios of some of these memory companies changes, that is a huge buy-in pressure on the Korean won. The government has essentially stated that they're happy for the won to strengthen. And so it doesn't seem particularly the case that you're fighting against the central bank or the government in being long the Korean won.
Yeah, just on that, Tom. Obviously, we got the big red candle in dollar won in around Christmas was that tax change around capital gains on foreign assets. Now that move got completely reversed at the beginning of January. I mean, we're just seeing a cease. Are we seeing any real repatriation flows yet, or is this all moves in anticipation of something that might happen, and then letting it go when they change their mind? I mean, I'd be really interested on your take and what you're seeing in terms of real flows.
So I don't think there has been much repatriation yet, and I think the yen and the way that's been moving and all of the election cycle and the uncertainty there has been really impacting the won. And so yeah. I think the reason it's become hyper volatile and those moves corrected is a yen thing. As soon as we get a bit more policy clarity coming out of Japan, I think you might start to see a bit of a cleaner trade, because I think, you know, the speculative sort of investors probably got in a bit early, got swept away by some of the stuff that's been going on in Japanese politics, with the you know the bigger majority and the sort of question marks on exactly what they want to achieve with the FX. But it's a decision which needs to be continually made. These memory stocks are going to continue to see massive profits throughout the entirety of next year, and every time they see those inflows, they're going to have to make a decision on how they want to, on whether they want to, you know, just send that money straight back out, or whether they want to keep it in the won. And so it's not like a will they, won't they. It's just this constant wall of inflows, and at some point, my guess is something has to give. They've all been told that they should be investing more of it in Korea. The incentives are starting to change. It's one of those trades which hasn't worked yet, but I think the reasons why it hasn't worked are pretty clear. It's because of all the gyrations that are going on in Japan, and so I think it's one which is still very much open, and the thesis has a very good chance of still playing out. Yeah, I agree. It hasn't worked yet. It's one which I think needs more time. But the fundamental pressure, I think, is so strong that at some point it will just start working.
And what is inflation in South Korea right now, Tom? So what are these real yields? I'm looking at the Bloomberg right now. So like short end's about 2.6 to 2.70, 2.90. What's the inflation rate roughly that you're using?
So I think the inflation is slightly above target. The central bank has been on the dovish side and has sort of refused to acknowledge that inflation is probably going to go up. If you look at the interest rate swap market, people are starting to price in hikes now. So we're shifting from that because, of course, the problem is with a currency like the Yuan is it has a lower interest rate than the dollar. So there is a negative carry associated with, with trade. And so, you stack that up with sort of extra unexpected volatility coming across the sea from Japan. And I think it's made it quite a difficult trade. The likelihood is over the next year, you're probably going to see interest rates go up in Korea. You're probably going to see interest rates go down somewhat in the US. And so we know that forward carry differential is gonna contract, and potentially could even go in the way of you earning carry to be long Korean won and short dollar. And I think when that starts to happen,
then the money comes in. Yeah.
Then the money comes in.
Yeah.
This carry trade is such a logical place to take us to LATAM. But just before we go there, Tom, can we talk about the Yuan, because that's the third leg of the stool in terms of Asian FX. We've just got dollar CNH spot and the vol again in blue here. The last sort of 36 hours, we've finally seen a check in that one-way traffic in terms of dollar CNH, much to Benny's chagrin. He's doing a lot of push-ups at 650 when we get there. But I mean, I'd love your take on where you see CNH fitting in with the whole East Asian sort of competition dynamic, right? I've always thought that yen CNH was an interesting cross to keep an eye on in terms of manufacturing competition in the region, and obviously Korea exactly the same thing. I believe you're a fellow CNH bull, and Ben, we got to stop this. But is that right, Tom?
Yes, I am. And so I should tell you though, I'm a reluctant bull because for me, and I think for a lot of macro guys, being long dollar CNH has almost been a bit of a free lunch over the years, because you kind of had this kind of grinding depreciation where you know that if you have a risk off event, you have a spike. There was these constant capital outflows, and you can see on the chart in 2022, being long the dollar, short the yuan was a very, very good hedge to an equity book. When equities struggled, it paid. It sort of paid. It allowed you to carry some equity risk, even when being long treasuries didn't really help. And so the way that I see it is 2022 was the death of the hedge from being long treasuries. And I think a lot of people really, really struggled to learn that lesson.
God, yes.
The one which remained the sort of the macro go-to hedge and was very much my hedge until really the last few months was being long dollar, short CNH. It's just been the gift which keeps on giving. It's sort of whenever you sort of had a bit of a blow up or anything happened, optionality was cheap because it was a managed cross. You bought some call options. The currency sold off. The dollar spiked relative to, the chart goes up. You make some money. You take off your position. I think it's those things which have been a gift to macro managers and other sort of investors for so long are quite difficult to step away from. I lost money trying to go long dollar, short yuan last year as a hedge, and came to the slow realization that the trade is over. The long-term yuan depreciation story was over. You're kind of getting to the end of the residential real estate bust in China, which was the thing which is, just keeping investors away. You look at the equity market in China, it's back. You look at the spending on the new iPhone in the latest cycle. You went from a trend which went down for 5 years to spiking back up above 2022 levels this year. And so, to an extent, it seems Chinese discretionary consumption is coming back. You have a huge amount of Chinese capital sitting outside of China. You've had these years of constant current account surplus. You've had very, very low hedging ratios. You've had corporates in China who just did not want to bring their capital home. They sort of thought there were better opportunities outside of China. They didn't want to invest in equity. They didn't want to invest in credit, and they didn't want to invest in property. I think as that changes, and as seemingly the message from Chinese authorities is they're kind of comfortable with a bit of currency appreciation, I'm pretty sure there's an awful lot of people who are sort of still stuck in just using it as a cheap hedge. And I think, much like the death of bonds in 2022, I think 2026 could see the death of dollar yuan as a good risk-off hedge for a trading book. And so I think that's going to be a long lesson for the market. You look at the cost of buying options for that appreciation trend that we've seen in the last 6 months of the yuan to continue. I mean, it's very, 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 very cheap. You can buy, let's say, 6.45 9-month digital puts for 7%. So if that trend rate appreciation continues, you're making 14 times your money on an option trade. And so for me, it's I didn't wish it to happen, but I think that sort of brilliant hedge that was long dollar yuan is over, and there's to go the other way is actually a very, very good asymmetric trade.
And so look, I agree. And the 25 delta butterfly 1 year is the blue, which is kind of a pure view of FX vol. And look at that. I mean, it's just low. So if you're going to take a position on that, I think you're right that using the options market is a way, which I'm sure there's a lot of people listening to this who have no access to FX vol, as an asset class. But it is, I agree with you on that. So let's go over, because I know you were recently, like me, in Latin America, and you visited our boy George Gammon down there as well. So tell us about your trip. Our show has been relatively bullish on LATAM. What do you share that sentiment? What did you think of your trip down there and all the people you met with?
Yeah, I think Latin America is doing very well. It always does well when the dollar depreciates. Their funding costs are reasonable. We're in a world where commodity prices are going higher. That's pretty helpful for Brazil, who's developing a lot of oil assets. I think the whole continent seems to be shifting rightwards. Latin America, like the politics, always used to be a battle between the extreme right and the extreme left, or certainly the extreme left and the right. And the extreme left was always funded and had this, they looked up to what was happening in China, to the former Soviet Union. And, there was this Marxist ideology, which was extremely potent. And it was seen there as a sort of like an alternative pole to the US sphere of influence. what I find quite interesting is, when you look at the world as a whole, we're sort of shifting away from a US monopole towards, both China and the US, to a multipolar world. Latin America, I think, is going the opposite way. Sort of Marxism, Soviet influence is declining. The US has basically announced, this is our backyard, no one else is invited. And as a result, I think you're seeing a rightward shift across Latin American politics. You can see it with Milei in Argentina. You can see it with the rise of the right in Brazil, in Colombia, in Chile. And, it's not necessarily a one-way trade as it was last year, but I think taking a longer-term view, things are changing. Things are changing in Latin America, and I think they're moving in a much more capitalist direction. And generally, when things move in a more capitalist, pro-Western direction, you should probably buy the assets of that region.
And what do you think? I talked with Rupert when I was down there, and I'm more to lean with you, which is just doing traditional FX carry, invest in the short end of the curve. I mean, I think when we talked when you were down there, we were talking about how attractive the short-term reals were for ironically the real, but yeah, I think that is more interesting to me than the equities. But because the equities, you take the FX risk and you kind of have like a super beta on them, and there's just not a ton of liquidity in those names. I mean, where are you looking to play? In that, are you more with mine or more on the Rupert side, or just both?
I think the equities will do well, but I think from a risk reward perspective, I think the FX is probably better. You have very, very sort of high levels of fiscal spending, and as a result of that, with relatively independent central banks now across the region, you've got very, very high real interest rates against it, which is kind of tough for equities. I think they'll do okay, but the fact that you can just stick money in the bank, or you can stick money in a short-term bond fund, and you can earn 10% real rates is pretty tough. And I know that some of the Brazilian real money guys are really struggling. They're the sort of guys who, they're our equivalent of hedge funds, really. They're accessible to a lot of retail investors, but they run sophisticated investment strategies. They might be along a bit of equities. They might, they'll be doing sort of various kind of trades. I think they're suffering a lot of, they're seeing a lot of outflows because you can just beat them with a high yield savings account. And so I think it's a tough environment for corporates, or certainly the sort of the PE ratios of corporates, because you've got this constant shift into funding those high fiscal deficits by very, very high real interest rates. And so I think when that's the case, you kind of want to buy the short-term bonds, you want to buy the FX. It's a good environment economically speaking, so I don't think the equities will be a terrible investment, but I think you want to be a bit more discerning than just buying the index. I think that's probably not
how crowded do you think LATAM carry is right now? Because we saw the August 24 unwind, right? And that was pretty brutal. Have we got? I mean, we're at higher levels now. We're at higher total return levels now. Have we got to the same level of crowdedness as we were that summer?
We're probably not far off. Well, then it was really the yen, right? There was a shift in sort of Japanese.
The long leg was all Mex and Real, right? It was.
So you got significant unwinds on the back of that.
Yeah,
it's hard to know. I think you look from a long-term perspective. I think there's not a lot of investors really in those markets. They're sort of seen as they're good for a short-term trend, and then people get out. You haven't had a lot of real FDI into those regions. I think you will see more of that, and that is pretty helpful. But at the same time, what happens in Japan again is probably crucial. We're at that pivot point. If you do see a shift in policy where they want, they should shift towards higher interest rates, they get pressure from the US to do something about their trend depreciation when their economy is doing quite well, and you see a strengthening yen, that's definitely going to be problematic. So, for me right now, it's not a position I've been adding to. It looks kind of stretched right now. Certainly on shorter term metrics, it looks stretched. Whether Japan pull the trigger and decide to implode that market, I don't know.
Yeah, it's interesting. I mean, so I want to switch gears slightly because we're sort of just coming up to the 50-minute mark, Tom. I just to finish on LATAM, I think it feels a little bit crowded in there on that carry trade. I think that everyone's pretty long LATAM stocks as well. So, I happen to believe that the politics is less important than people say in LATAM. Brazilian equities, have roared under Lula before. So I'm not sure it's a shot in the forehead if the election doesn't go out as some of the cheerleaders want. To me, if you think you're at the foothills of a big bull market in commodities, Brazil's going to be just fine. Anyway, I wanted to talk about a less loved market. And with two Brits on this podcast, can we talk about the UK? I mean, the narrative, particularly on social media, is that the UK and the UK economy is swirling around the gutter. These are the UK yield spreads. What's going on in the gilts market, Tom? I know you trade it actively.
It's been a tough one. You've had continued policy disasters in the UK, and so you've had a very difficult backdrop in which to invest under. And I think at the same time, so you obviously had that Liz Truss debacle on the chart. And you've done this chart relative. So this is just UK relative to the whole of the developed world, right? So this is UK spread over sort of everything, right?
Yeah.
So it's my belief that there's something bigger going on in long end yields outside of the US. US for a long time has always been a place where people save for their retirement through equities and through defined contribution pension schemes, whereas the UK, the Netherlands, Japan, and other places all had these defined benefit where pension schemes where someone guarantees you a certain amount of money at the end and then sort of tries to make the investments work to reach that. And what that means is you have a huge amount of investment demand for very, very long-term fixed income products. It could be 30 years, even 50 years. The UK swaps curve goes out to like 60, 70 years. And interestingly, the yields always used to be downward sloping towards the end of that curve. And the same in Europe. The reason being that there was just this huge demand for those long-term duration assets. And that's hugely changed. The UK is almost, apart from small parts of the public sector, has almost completely moved away from those schemes. Holland has slowly but surely moved away from them. The way that the Japanese system works is, again, moving away from those long-term liability investments. And as a result, you've had this constant upward pressure on the back end of the global bond market. I'd say the US is the exception. It tends to have its own dynamics. It's bigger and didn't have that same flow dynamic. And so I think that's been part of the problem for the UK. So there's two things. There's one, which is the their premium versus other markets. But there's also this long-term factor, and trying to assess whether that long-term factor has finally come to an end, I think, is the critical one. Certainly, we should see less pressure. When you look at the way, governments have sort of slowly but surely worked out that they've been issuing too much of this paper, and the right amount of this paper to issue is negative. They should be buying it back and sort of removing it, because it's not just a flow thing. It's just people needed to be active sellers of this stuff on their balance sheet. And I think this is what turbocharged the Liz Truss issues in the first place. And it's the reason why the back end just keeps going up everywhere outside of the US. If you look at 30-year yields, it's much more than this. The 10s 30 spread has gone up, and all of these back end yields have gone up even more. I think that's probably coming to an end, and so this global factor is starting to become less relevant, and so you can actually invest in long end paper finally, I think. And with that, I think the UK does actually look pretty interesting. Inflation's coming down. You've seen significant sticky inflation due to the way that the government dealt with high energy and high gas and electricity prices. When you had the cutoff of Russian gas, global energy prices are coming down. Some of that sort of back pay that they forced UK consumers to pay for the government sort of capping the price of gas and electricity back in the day is coming to an end. And with it, I think you can start to see short-term interest rates come down, certainly relative to the rest of the world. So yeah, I think the UK is pretty interesting. And it's more for me is that sort of long-term duration sell-off outside of the US. It's still just unclear whether we've got another leg in that or not. You've seen, if you look at Japanese 30 years, they just keep going up and up and up and up and up. We've seen a little bit of respite over the last month or so, but potentially we've got further to go. You've still got Japanese yields sitting at significantly lower yields than the rest of the world. And so, yeah, I'd say a tentative long in UK rates makes sense, but with kind of one eye on what's going on, because maybe we've got one more sort of long end duration puke left to come before it becomes a clean trade once more.
Okay, what about equities?
Wait 1 second, real quick, because you did see this recently in Japan as well, right? Forever it was like, oh, it's blowing out. And recently we've seen flattening. I mean, we started off this week after the holiday here in the US, Monday night US, 10 bips down on the Japanese 30-year. So I think what you're talking about is real. And it's been such a blowout, Hunger Games dynamic, what you're talking about. And now, there could be a trade there. Rupert hates bonds, just so you know, Tom. So this all just irks him. The same way when Wales beats the Three Lions. And so I'm with you on that. Go ahead. Let's talk about equities.
Yeah, no, I just wanted your take, Tom, on equities. I mean, I'll just full disclosure. I mean, I've had a basket of UK small and mid cap investment trusts on. I first put them on. This is just the 1 year chart. So no, I first put them on in late 23. Did very well. Took them off after the Starmer election. And then I put them back on after Liberation Day last year, and they've, this is UK small and mid cap investment trusts. These are closed-end funds trading at a discount to NAV, often double digits, and they've outperformed global equities pretty comfortably in the last year, and nobody is talking about this. Why do you think that is? And they're still cheap.
I just think people are once bitten, twice shy. People have been talking about how cheap UK equities have been for many, many years, and it never really panned out. It never really sort of posted those returns. now maybe that's starting to change. I think the thing which has been missing in the UK equity market has been like a real champion. You look across European markets, you've got the French luxury brands. You go across to the Netherlands, you've got ASML. You have
in Germany.
Yeah, you've got a lot of champions there, right? And the UK just, I guess the closest thing has been ARM, which was sort of taken private and then relisted in the US. There's really been no sort of really well-performing company listed in the UK. We sort of missed. We've missed the chip stuff. Our healthcare stocks have been subpar compared to the Ozempic maker, who I for some reason can't remember the name of. Novo. We just have and the luxury brands that we have been nothing like the French, and so there's been a bit of a lack of a champion to sort of attract equity investors into the UK. And so it's really been left as more of a sort of a smaller mid-cap play. And I think
basically a hunting ground for private equity. I mean,
it's a hunting ground for private equity, and it's a hunting ground for private investors as well. Like I think perhaps you just haven't seen those big institutional investors come into UK markets because there hasn't been a big drag, a big IPO. Potentially, maybe if you do get the Revolut IPO in London and some others, you finally start to see some of these big American institutions actually starting to look more closely at the UK, which always used to be a big hunting ground for them and sort of become less so in recent years. But
yeah, the trouble is that the domestic buy side in UK equities got hollowed out from the mid-90s onward. Most pension fund assets have a significantly larger weighting in, well, I mean, they have a minority weighting in UK equities relative to US. And that's a function of what you were talking about with the structure of the pension market, right? Most of the pension market was focused on liability management products, solving for that duration bogey, and equities were irrelevant. But yeah, I mean, I listen, I think it's been a bit of an interesting stealth bull market, and the way I like it is that, provided there is still a private equity community after this software meltdown, there's always been a bid under quality UK mid caps, which gets hit, and I still like the trade here, and I'll stay in it while it's still working.
And
I think there's a lot of good stocks under the hood there. Yeah.
Do you have a view on sterling? We're talking about rates, we're talking about that, but like if rates come down, I'm not going to bring the chart back up, but it's had a positive spread versus the US. Is there like a dynamic of, hey, we got to keep rates up in order to keep capital? If rates start coming down, what's your view on sterling here? I mean, I know you're not bullish on the dollar. What do you think dollar sterling, for example?
So I don't think the central bank really cares. So if they think domestic inflation is coming down, they'll cut rates. If sterling goes down because of that, they won't be particularly unhappy about it. That won't really sort of factor into their considerations. I to be honest, I don't really have a strong view. We've rallied a fair bit off the absolute lows. Sterling doesn't look particularly expensive. It also doesn't look particularly cheap, and so I don't have a very strong view. I mean, you look at sterling versus the dollar. It has a relatively high level of vol, and typically doesn't tend to go anywhere. So I don't really have a structural view, and it's expensive to take one through options, and so I don't tend to get too involved.
Sometimes that's the best policy. If you don't have a strong view, just hands off.
Sit on your hands. Tuck them underneath.
All right, let me switch gears here for the final little segment. I got you. I know you rode the silver trade. I know when you were on George's show, you were talking about being long silver. The squirrel caught a lot of the silver trade, and I caught the silver top on the short side. So where are we at now? Where do we think precious metals are going after this, solid correction? is what's next? One back to a high, or are we going to retest 50, or is it kind of just another hands off? We're kind of in the middle, and it's a no touch zone.
So I think the miners look very, very cheap relative to the metals, and that goes across the board. Whether you look at your platinum miners, your gold miners, your silver miners, they've essentially really never been cheaper in sort of multiple terms. And if you think that sort of precious metals stays where it is or goes up a bit from here, I think you're more likely to make money being in those miners than you are investing directly in the metal. So that's one point. It's pretty tough from here, right? We've obviously seen a lot of volatility in that market. I think the easy money has probably been made. Your guess is as good as mine for the next couple of months. Like, ultimately, for me, it's one of those ones where you have those long-term catalysts, which I think are very much still there. There's a big demand for silver, for photovoltaics, as well as for investment demand. There's a big investment on a sovereign state level for gold, which I think will continue. I can't see China sort of shifting away from its current account surplus anytime soon. And even if you do have a deal with the US, ultimately, are they really going to want to acquire more US assets? Do they think they can leverage the spending power that they can sort of gain from parking their excess cash in the dollar? I don't think so. You never really know what's going to happen next. If you can just have a big pile of gold, you know that no one's going to steal it off you. If you've got, if you add to your T-bill collection, who knows? And so the long term is still there, but in the short term, I think a lot of investors got over their skis on precious metals. There was too much leverage. There's been a lot of pain. We haven't yet seen much in the way of sort of stories of people going bankrupt on the back of it. I think there will be, we will see some of that. We will see more pain being realized. We don't really know big players who've been hurt, but I'm pretty sure they would have been. And so my fear is, in the short term, we could have a little bit more to come, which makes it tricky to sort of execute that long-term view. You've got like if I was to leave it for 5 years, I would very happily be long gold, I'd be long silver, I'd be long all of these things. I don't think that demand is going away, but just getting through those next few months, I think, makes it a bit challenging.
So Tom, just on the miners, are you concerned that the miner story is yet to be challenged by rising energy prices, and could that trip them up?
I think they've suffered. I think they've suffered on the rising energy price part already. I think one of the reasons it took so long for the miner story to get going is because once they started to become profitable as gold went up, they suddenly kind of they put their energy costs and their actual, their all-in cost of production, they shifted it up to the level which it actually was at, because they knew that in a precious metal bull story, they could probably get away with it. And, they were sort of misreporting their true cost of production. Now we've seen that big bull market. I think where they sort of state their energy costs at are probably pretty fair. You take your bad news in those early innings of a bull market, you state your true costs, and you don't need to take too much of a hit. I think that's happened. I don't really think we've got another round of those cost increases to go. Like, you can make an argument that global energy prices are going to go up from here. I'm not so much in that camp. I think where energy prices are right now, they're pretty much fairly reflected on the balance sheets of those miners. And so I don't think there's more recognition at a balance sheet level to come. Yes, certainly if you start to see oil prices, gas prices go up, then yes, they will need to do that again. that's obviously a risk.
Okay, that's fantastic. That's fantastic. I'm actually writing about gold miners this weekend, so it's timely. I wanted to pick your brains about this.
Absolutely.
So Tom, I think we're sort of we're at the sort of stop zone now. But why don't you just tell everyone about Trium, if whatever compliance allows you to tell us? I'd love.
Sure. Yeah. So Trium is an alternative assets manager. I think it's now around $4 billion. So I run a UCITS macro sleeve and sort of like an external fund. And I've been running that vehicle for coming up to 3.5 years now. So I invest across currencies, commodities, equities, bonds on a sort of a high level discretionary macro framework. So that takes me to positions in commodities. It could be in gold, it could be in Latin American FX, it could be in Japanese bonds. We'll typically stay very high level, so not so much on the level of single stocks. If we're investing in gold miners, we'll invest in a big basket, which we think kind of covers the theme, and we'll leave the differentiation for which ones are good, which ones are bad to other people. We don't consider that our expertise. We just, for us, what the critical thing is to get in and out of what we think will be the driving macro risk factors in as efficient way as we can. And so we tend to stay high level. And yeah, that's what I do.
Fantastic. And if people want to get in touch with you, how can they do that? Are you on the socials, or are you on the dreaded LinkedIn?
So they can go to the Trium website, which is Trium, which is TRIUM-capital.com. You can get in touch with me on LinkedIn. I'm on Twitter. I'm not as active as I was. My handle is Tostro, which is TOSTRO. Feel free to drop me a message there, or whatever method suits.
Perfect.
All right. Well, thanks,
Fantastic.
Tom. We appreciate it. We'll have to get you back, because I know as a guy who talks to you often, we can always just talk about markets, and you guys can just, the World Cup's coming up, so maybe we'll have a little Welsh Three Lions action to talk about maybe at some point here. But anyway,
I'm going to the qualifiers next month, and so we've got 2 games to win. We might be there. We'll see. Remarkably, Welsh football seems to be doing better than Welsh rugby at the moment, which is very, very rare. So fingers crossed. The football can make up for the bad performance of the rugby team. But appreciate you guys for having me on. And
Tom, thanks so much. Next time I want to probe you about your longer term energy views, and I want to check in that you haven't sold your house for Bitcoin. But thank you so much.
That's another time.
That's brilliant. Take care.
All right.